Hello, everyone. This is Dr. Duru from Ahan Analytics, and I'm going to go through a lot of charts in quick time. The market's very volatile, changing every day. So I don't want to get too stuck on the current snapshot for today, but there are some important charting lessons to go through. All right. First of all, we're looking at Swing Trade Bot. As you all should know by now, I am a subscriber, big fan, and this market recap table says it all. Everything's down. All the long term, mid term, and short term is down. This is a classic sign of a bear market. I know there's some other indicators out there, 20% down from all-time highs, but there are plenty other reasons to believe that we're already in a bear market. I've made the case on my blog, drduru.com/122. You could check it out there as well. So anyway, all the trends are down. ADX, which is a I believe an indicator for momentum, is strongly negative. And we also have technical signals. The lower Bollinger Band Walk means that stocks indices are just going straight down. This is classic bear market action, folks. Let me just show one other thing on Swing Trade Bot, then we'll get to the charts. This is their percent of stocks above their 50-day moving averages. You can see the weakening in market breadth, particularly starting at the beginning of this year, and then boom, market breadth has been collapsing. Until this market breadth is no longer collapsing, sorry, the fact that this market breadth is collapsing is yet another sign that we're in a bear market and it's collapsing to what I call oversold. Let's go to TradingView. And this is MFFI, or what I call AT50. And you can see I've marked off the oversold condition, which is at 20%. And this is what I mean by straight down. We've gone straight down to oversold. This is bear market action. If we go back to, and just bear with me a quick second here, I'm going to go back to 2022. Another thing that I'm going to be looking for in the coming weeks and months is the market continuously going back to oversold conditions? That is classic, also classic bear market action. You could see back in the bear market of 2022, this is exactly what happened. We first got to oversold at the end of 2021, and then again, boom, boom. Here again, boom, like multiple places. Let me actually scan out. You could see that in 2022, we just kept hitting that oversold. And of course, we had strong bear market rallies, and the strongest one was in the summer. You can see we shot right through the overbought threshold. So anyway, this is the kind of thing I'm going to be looking for when we are going to inevitably bounce because things are oversold. Lots of people are seeing lots of stocks that they've wanted to buy. They're quote unquote cheap. So people are at some point going to rush in and scoop up these bargains, and we will see the subsequent rally. So anyway. Again, going forward, looking to see whether the market can bounce off or away from oversold conditions and stay away. Otherwise, again, more bear market action. All right, let's go through the indices. S&P 500. In a bear market, there is no support. And that's what that whole lower Bollinger Band, remember that lower Bollinger Band walk? That's what the S&P 500 is doing. It's just slipping right through here. You can see it barely paused at important support levels, like the 200-day moving average, which is a sign of longer term health. And I mean, it's just going straight down with very little break. So again, in a bear market, there's no such thing as support. You can draw all the lines you want all day, and the market will not respect them. That's bear market trading action. We could see that in the NASDAQ as well. Boom, straight down. We had a little bit of a pull away yesterday, but that didn't last. And now the both the Nasdaq and actually the S&P 500 are back to new 6-month lows. And our favorite friend, small caps, it's just creeping ever closer to the official or the conventional definition of bear market, which is 20% off the all-time high. I mean, let's just call it what it is. I mean, the small caps ETF, IWM, which is the ETF, is essentially there. So again, bear market. And I'm not saying bear market over and over again to scare you. I just want us to be very realistic about the conditions in which we're trying to make trades and trying to make investments. Oh, and of course, My other indicator of long-term health, this is market breadth with the percentage of stocks above their 200-day moving averages. It plunged again today. Now it's at 32.6%. Another sign of bear market action is that we have this straight drop of stocks just continuously breaking down below 200-day moving averages. And that's all the way, it was last this low at the end of 2023. So very, very bad. Oh, and I've also pointed out that because of this straight down momentum, it means that we have a high chance of going all the way down to at least this low. Hopefully, we don't get down as far as this low, but that would be consistent with bear market action. All right, now there's a bunch of stocks I want to go through. I know sometimes I take a while on these, but I'm going to try to go by fast because there are a lot of snapshots that I think are very instructive that are important to take a look at. Let's go. Lightning round. Apple. Apple, classic sign. There is no support in a bear market. Look at that. I mean, I've been quite surprised. I mean, technically, Apple was a short right here and definitely right here, but it's been closing well below the lower Bollinger Band, so it's overstretched to the downside. It's getting more and more oversold, and it's just dangerous to short, but it's also dangerous to buy because it's like buying a falling knife. So all you can do on stocks like this is just sit back and just let the sellers have their way at it until they finally get exhausted. And hopefully some other technical pattern comes up that shows that sign of exhaustion. For those of you who are more conservative, all you have to do is wait for Apple to get back above the 200-day moving average line before you decide to buy. And hopefully it will hold support on that rebound and we'll be out of the bear market. Okay, let's take a look at some other quick stocks. S&P 500, S&P Global broke down below the 200-day moving average. It is now testing actually it's testing its low for the year. And actually, I guess it's really testing this low in October. So that's another example of a 200-day moving average breakdown. Amazon has been very disappointing to me. It failed to hold the 200-day moving average support. It looked pretty good for a while last week. And here you can see it's struggling to hold on, but it looks ready to give out. If a stock like Amazon goes even lower than this, again, it'll be another clear signal that we are in bear market trading action. And if you need any more reminder in the retail space, XRT, the Spider Retail ETF, oh my goodness, this is terrible. Um, Sorry, I don't mean to be dramatic. Let me just take it down a few notches because I don't mean to be dramatic. It's just what's happening when I'm trying to go fast. Okay, so XRT closed at wow, it was last this low in December of 2023. This is a index of retail stocks. You can see the lower Bollinger Band Walk. This is very, very steep, and again, sign of bear market trading action. And actually, let me just take a chance. Whenever a rebound happens, and I'm saying it's inevitably there's going to be a sharp snapback. We just don't know from what level. Look at all this room that's above. I mean, the flip side of these ugly charts is that whenever the rebound starts, there is a lot of room to do short-term trades, even if it only gets back to the 20-day moving average resistance, which is this dotted line. But notice now that all three important trend lines are pointing downwards, XRT has a long way to go to get back to even some sort of trading range like it was in for much of last year. Okay, let's keep going through the speed round. Let's go to Hood. This was actually one of my favorite ways to play meme stock trading and crypto and everything. Hood has completely collapsed since. What's odd about a stock like this is that, earnings seem to be confirming of a lot of bullish action going into earnings. It popped 14% and then it even followed through 2.3%, but it's been practically straight down ever since. I'm long Hood. I'm looking for it to hopefully hold support here, 200-day moving average, and then buy some more. But again, guess what? In a bear market, there is no such thing as support. So I'm going to be very leery if Hood gets here. And look, the momentum is essentially pointing to that spot. Another reason why this may not hold is that so many stocks like this that took off after the election are reversing all of their post-election gains. So if hood is about to follow into that same pattern, well, it's got to come all the way down to 25. And if it gets down that low, I'm definitely going to get aggressive and buy up because at some point, trading will be vogue again and crypto will be back in fashion again and hood will be a beneficiary. But it's just an ugly, ugly period right now. Okay, this is a big disappointment. Intuitive, surgical. I actually bought a few shares hoping that support was going to hold when I saw this breakout, and I didn't even notice that it closed the day below the 200-day moving average. This is an example of why sometimes it's better, particularly if you're conservative, to wait for what I call confirmation. So I should have actually waited for the close, first of all, to hold 200-day moving average support, but then also to have two closes above that. And that would have been a more solid buy signal. Now I just have to wait this out and see how basically how low it's going to go in this bear market. The reason why I'm not selling right away is because I did not buy this as a quick trade. I really bought this hoping to hold on for long term. So I have some buy spots further down here that I hope to continue accumulating shares in Intuitive Surgical. And again, that's just me. I'm not giving trading advice. Do your own homework, and of course, dial things according to your own risk management. Costco. Oh wow. I mean, Costco just broke down its 200 it just broke its 200-day moving average after having a terrible post-earnings reaction, 6.1%. It broke its 50-day moving average. Now, a stock like Costco is interesting because I mean, it has been well loved for a long time. It has had a very nice uptrend since breaking out, what is this, in December of 2023. So, if we're in a true bear market, I hate to say this, but a stock like Costco is going to be a source of funds where people are going to be rushing to take their profits, and it could literally reverse this entire move. Costco on a valuation basis is extremely expensive, so you don't know if we do have a bear market, just how bad sentiment will get. But it could get to the point that Costco becomes true value on a valuation basis. But who knows? We just don't know. But that's just something to be cautious of, that a well-loved stock that falls out of favor can get very ugly very fast. And this is just the beginning of ugly very fast. It's broken down to 200-day moving average, so it is in its own bear market. Again, my definition of bear market is anything that is trading below its 200-day moving average, because that's a sign, that trend line is a sign of long-term health. Okay, so also on the retail side, Walmart, huge surprise after it gave up the ghost from its all-time high in this earnings report, 6.5% loss. It, kind of hung around here. I thought that was going to be a sign of a rebound to quickly fill this gap because oftentimes gaps are made to be filled. Once it broke below the 50-day moving average again, the sellers had at it. And now it's careening towards the 200-day moving average. Like Costco, Walmart has been amazingly loved. It broke out, I bet you it was probably December 2023 as well. Let's see. November 2023, then that was a fake breakout. And then it finally truly broke out at the beginning in February 2024. So it's had a good year. So even with this drop, Walmart has had a great gain over the last year. So again, if sentiment continues to get worse, a stock like Walmart, it's also very expensive on a valuation basis. If it falls out of favor, it can go down very fast. And Walmart is actually could be a very good sign, just like Apple is a good sign of sentiment. Walmart could be a good sign if it just slices right through its 200-day moving average as well. Okay, home builders. Home builders, I called the bear market a while back. You can see here, this is ITB, which is the home construction ETF. It's dominated by home builders. The 20% correction from all-time high was back here. It first breached it at the end of last year. You could actually think of this weakness in home builders as being an early warning sign, the classic canary in the coal mine for what was to come for the rest of the stock market. And I don't have time to go into it now, but I've shown this in my blog in previous years, how this works. There is this false moment when the December CPI came in softer than expected, and long-term interest rates came down. People just, pushed that auto button. The algorithms, the robots just bought all rate sensitive stocks and indices, and it just automatically went up, but that was a fake breakout. And now you can see ITB has just been going straight down. And this is very, very ugly to me because look at this. I'm scaling back. I've drawn some lines here. There's this line that was critical support from the 2024 triple bottom. This was extremely important for ITB to hold. It did not hold. What have I been saying? In a bear market, there is no such thing as support. ITB, its bear market has deepened. Now that it's down here, who knows where the selling is going to stop? Um, I'm not even going to guess how far down this can go. Um, I'm long ITB. It was for the what I call the seasonal trade. Again, don't have time to get into it now, but you can go to my blog to check out that trade. It's been a complete bust this particular cycle. It had a great run the last 2 years and in 2021, but this is a complete bust year for this trade. And this chart really concerns me. And I'll be revisiting it several times in coming weeks. Goldman Sachs. Let's look at the financials. Financials are also warning us about a bear market. Goldman Sachs confirmed a 200-day moving average breakdown. Goldman Sachs also reversed all of its post-earnings gains and filled that gap. Post-election gains and filled that gap. Like I said, a lot of stocks, I wish there was an indicator for this, but a lot of stocks have been rolling back all their post-election gains, filling this gap, and the really bad ones have actually been trading are now negative since the election. It looks like Goldman is on that path. JP Morgan, another big financial bank, it just broke its 200-day moving average today, as if to tell us it too wants to finish filling its post-election gap up. So again, another warning sign. Okay, let's take a look at a stock like Instacart. Instacart had a rough IPO. That was it back here. And it traded water, and then suddenly everyone loved it. And everyone loved it a lot after, ironically, after a bad earnings report response in November, suddenly people got love for this stock, only for it to disappoint them again. So given these two subsequent, consecutive disappointments, I think that this 200-day moving average breakdown is particularly bearish, and Instacart is likely to go back to whatever sentiment was holding it back earlier. Again, it's not this is isn't technically a prediction, it's just the risk, downside risk that I'm pointing out. Okay, let's look at the cruise lines. Um, you see the familiar pattern, broken down, confirmed 200-day moving average breakdown. The post-election gains were long gone earlier this month, so it's particularly ugly. If I scroll back, though, Carnival Cruise is still in the middle of trying to recover from the pandemic. So it's probably not a stock you want to mess around with at all anyway, because there are stronger cruise lines like Royal Caribbean. Royal Caribbean is actually one of the few stocks left still trading above its 200-day moving average. So I have my eye on this. I know in a bear market, there is no support, but I'm still going to be watching this for a buy if we find ourselves in an oversold um, bounce. And notice again, um, Royal Caribbean is has now reversed all of its post-election gains, but it's still trying to hang in there. So that's why I'm this stock is particularly interesting. And you can see Royal Caribbean, unlike Carnival Cruise, got over its pandemic blues and just went practically parabolic after that. So this is a particularly strong cruise stock. These are the kinds of stocks that you want to buy coming out of however long this bear market lasts. Or if you're a big time aggressive risk taker, you want to at least buy stocks that still have some modicum of uptrend left in them because they should be strong coming out of whatever kind of bear market we're going to have. Whirlpool, I should have showed this one during the home builders. You can see Whirlpool gave us a huge warning. This was a massive 16.5% post-earnings loss at the beginning of January. So that told us this is one more sign that was telling us that consumers are weakening, or at least the stocks of consumers are weakening. But then again, Whirlpool has not been a good stock to buy anyway, and it peaked in 2000 between 2021 and 2022. So it's probably not a stock you should have had on your buy radar at all anyway. And Whirlpool's an old school stock. Let me go to the month chart and you can see um, how much of a fake out the post pandemic or the pandemic day rally, sorry, pandemic era rally was. I mean, people of course were buying homes like crazy, so adjacent plays like Whirlpool benefited, only to disappoint, and it's rolled back all of that. So Whirlpool shouldn't really be on a buy list unless you're just trying to do some sort of quick trade. Sorry, I should say it's not on my buy list, but you decide for yourself. Okay, we're almost finished. Let me look at some more positive stories. Actually, this is not a positive story. Uh, this is another chart. If you see a chart like this, again, be very cautious. So, um, FFI, sorry, F5. I think I call this F5 networks. It had a very good post earnings surge of 11.4%. It kind of made a new high after a week or two, sorry, after about 2 weeks, but then came straight down. It's reversed all its post earning gains, broken down below the 50-day moving average, and momentum again is pointing down that lower Bollinger Band Walk, and it looks like it wants to hit the 200-day moving average. So this is, if I see a stock in the middle of the 50-day moving average or 200-day moving average, I am definitely not touching it because I'm taking just too much of a chance. This is like 50-50 in terms of whether it'll turn around on a dime and go back to resistance for a nice quick trade, or it's going to just continue to plunge right to the 200-day moving average support. Okay, so now let's take a look at some better stories, and there's some actually surprising ones. So like quantum, I've been bearish on the quantum stocks, but D-Wave Quantum, it actually survived its earnings. It soared 18.7%. So it's looking a little bit more constructive. I mean, I'm not going to buy this at all. I had no interest in it, but I just took interest in, wow, here's actually a very speculative stock in the middle of a bear market that's looking constructive. So these are the green shoots that you want to see if you're going to be very aggressive buying into this kind of market. You want to see stocks like this actually hang in there at least, if not do well. Here's a stock that I am in, which is Mercury Systems. I bought this back here when it tested the 50-day moving average. It was before I really appreciated that we were in a bear market trading environment, but I really love the setup. It tested 50-day moving average support just as it filled its post earnings um, gap up, assuming that, something people haven't completely changed their opinion on what those earning reports were. It should hold in there. I think it popped today 7.1% because of an upgrade. So I expect a stock like Mercury Systems to really soar if an oversold bounce comes in the coming days. And of course, I'm hoping it comes quickly because this is just one of the few bright spots I have on my screen. Okay, Intel, long-suffering Intel. I bought it a while ago. I'm still in the red, but it was good to see that they got a new CEO. It popped 14.6%. But the caution here is that it's below 200-day moving average resistance. But this is such a broken chart and broken stock. It could just go any which way in the wind that it wants. But I still was glad to at least get some salvage value there. Okay, one more. I think I have one more, which is gold. Gold broke out to a new all-time high. Let me actually move this over here. And I haven't written about gold in a while, but I am a perma bull on gold. And I happen to have a new call spread position on that survived this dip. And now I'm happy that I'm in it. I have a core position in GLD that I've been holding for a very long time. So the gold breaking out here is sort of a confirmation that fear is starting to increase. Okay, so let's end it there. I went through a lot of stocks. If you have any questions on any of these chart reads, if I use any terms or jargon that you need help with, just ask in the comments. I'm happy to answer any questions. In the meantime, everyone be careful out there. The trading is treacherous. If you're a long-term investor, of course, create your buying list, but be very judicious. Don't buy everything all at once. We just don't know how long these bear market trading conditions can last, and you could get fooled by oversold bounces that get faded by sellers who are quick to take profits. Okay, that's everything I have. Take care, everybody, and check in I'll check with you next time. In the meantime, subscribe to the channel, or you can check me out at the blog at drdewar.com/122. Take care and be careful out there.